You're watching Confident Real Estate, and I'm your host, JC. As we've covered in videos in the past, real estate is the greatest wealth creation mechanism for investment that has ever been created. It's the same reason why every single person listed on the annual Forbes list of Richest Americans has significant holdings in real estate in their portfolios, because it's just a wealth creation tool. But let's say you already make decent money in your profession and you have plenty of money to invest, but what you don't have is the time to actively find deals, talk to real estate agents, analyze deals, manage tenants, manage property, and on and on and on. If you have small children, then you already know what a premium time for yourself is, let alone active hands-on investing. I'm right there with you. I have two small boys of my own and I love them to pieces, but they are exhausting. So if I didn't do real estate as a profession, maybe I wouldn't have as much time for actual active hands-on investing as the next person. So if you already have a career and you have money to invest, there are ways you can invest in real estate without the time suck that active investing requires. So guess what we're going to cover in this video? You guessed it. 3 ways to passively invest in real estate and still benefit from the great financial returns that real estate can provide for your portfolio without neglecting your business or career with the time management that it requires for active investing, or neglecting your family for that matter. Before we get into the passive investing options that await you, do me a favor and hit the like button down below, because it feeds the YouTube algorithm. And if you haven't joined our YouTube Confident Real Estate family yet, consider hitting the subscribe button while you're at it, because we really do offer a lot of great information that, I know I'm biased, but I don't see a lot of other channels offering as detailed or as different a variety of information as we offer on this channel. And again, it helps grow the channel and I appreciate it. If you don't have money, then sweat equity is the only thing you have to invest in a real estate deal. And it's a combination of your action and your time. But that requires a lot of active investment and action on your part. But if you have money saved up and you want to invest it in a deal, but what you lack is time, then passive investing is perfect for you. You're going to be investing in someone else's deal. And there are multiple ways to do that, but the 3 most common ways that we're going to cover in this video are crowdfunding, real estate investment trusts, also known as REITs, and most interestingly, syndications, which we're going to leave to the end of this video to cover because they're really quite fascinating. If you've never heard of them, you're going to find them interesting. Now, I really could do a video on each of these topics, on crowdfunding, on real estate investment trusts, and on syndication all by themselves. But for the purposes of this video, we're going to give you a summary and a preview of what each of them really entails. Crowdfunding is where you use an online company that coordinates funding for deals all across the country. And you get to look and review each of the different types of deals that developers and investment firms are looking to raise funds for. Now, the caveat to crowdfunding is that you typically have to qualify as an investor before you can actually invest your money in any particular deal. And in many cases, that requires you to be an accredited investor. And if you're not sure if you qualify as a accredited investor, I'm going to leave a link down below that you can click on to check out to see if you actually qualify as an accredited investor. But I will tell you, if you've checked it out before and you didn't qualify, the rules just changed. In October of this year, 2020, the rules changed and you may qualify as an accredited investor now. So definitely click that link below and check it out. Now, if you do qualify as an investor, you'll have a whole proposal about the deal that you're interested in investing in, as well as the investment firm or team of people that put the deal together, or the developers that are developing this ground-up construction new project. And you can really get the thorough details on what you're looking to invest in, not only about the project, but about the people involved. And it gives you the opportunity to invest your money in a real estate deal that you could not put together yourself, most likely, because it is a much larger deal with a whole team behind it who has tremendous experience, in most cases, doing similar deals in the past. Real estate investment trusts, also commonly known as REITs, are companies that invest in or finance income-producing properties. And the largest ones are commonly found as publicly traded companies on stock exchange. So you can go and actually buy stock in a REIT. And instead of investing in just one deal, you're investing in the totality of their portfolio. And there are different REITs that invest in different types of asset classes. You can invest in a REIT that specializes in industrial warehouses across the eastern or western seaboard. You could invest in a REIT that specializes in assisted living facilities, or one that specializes in investments in multifamily housing or student housing. There are even REITs out there that focus their investments into cannabis facilities. Yeah, that's a thing. Due to the regulations surrounding REITs, they are required by law to issue up to 90% of their taxable income out to their investors as a dividend. So there's going to be cash flow if you invest in a REIT, just not monthly cash flow. But at the same time, because REITs are a stock, it's more like you're investing in the stock market than a physical property. They are highly liquid. And because of that, you're missing out on capital appreciation. That capital appreciation is a huge part of why people invest in real estate. It's one of the biggest compounding appreciation and interest components of wealth building. Compounding interest, wealth building. You've heard that before. Capital appreciation is the compounding interest factor in real estate investing. And when you invest in a REIT, which is a stock, you're not getting that. You're getting the liquidity of cash flow, but not the capital appreciation, equity building that comes with investing in an actual piece of real estate. Now, I'm certainly not a financial advisor, and I would never advise you how to invest your money. But I will say I like to be diversified, and I do invest in REITs for things like industrial warehouses and cell phone towers and asset classes that I think are really strong and have great potential, but are not necessarily asset classes that I know how to manage or want to learn how to manage. So I'm not going to actively go out and buy warehouses and start to learn how warehouses work and how you lease them up and things that are outside my wheelhouse. So for those, I diversify my portfolio by investing in REITs that actually do invest in those asset classes. Now we get into syndication, which is an investment into an investment fund for real estate deals that are typically larger in size and perhaps a little bit harder to understand and more complex. But that's why you invest in these deals, because they're a little bit over your head and you're looking to invest more in the team that's doing the deal than the actual property itself. You want to make sure that the team who is running this fund has tremendous experience in real estate investing, because these are deals, again, that are far more complex than most investors can handle, which is why they have tremendous upside, because a lot of investors shy away from them. These are deals that are going to require a lot of money, a lot of time, and the investors will get paid back, you being one of the investors, before anyone on the investment team who put the whole deal together will see a dime. So it's a win-win with huge incentives for the people that put the deal together. But that's why they're usually quite gifted at what they do. And typically, a lot of these investment funds are comprised of former real estate attorneys and people who worked on Wall Street in real estate sectors and people who've been developing and investing in property for decades upon decades. And they now have the resources and capabilities and experience level to put together a highly complex deal that you get the opportunity to invest in. And again, you get paid back before they do, up to a certain threshold, and then they start to collect payments alongside you the more money they bring in. And that's why these deals are typically set up to be highly successful, because the people that put the deal together, they got a lot riding on the line and a lot of their time before they see any of the fruits of their labor. So those are 3 ways that you can passively invest in real estate and reap the benefits and financial rewards that come with investing in real estate long term without having to go out and find a deal, structure a deal, and actively manage that deal long term. And I promise you, if you passively invest in real estate, you're going to make a lot more money than the bank's going to give you for leaving it in their savings account, where you're going to get, 1% or even less? The only thing you need to do is take action, whether you're actively or passively investing in real estate. If you don't take action, you will never see any gains. That I can promise you. If you haven't already, hit like, hit subscribe, and let us know down in the comments below if you've had any success passively investing in real estate, or if you have some experience in anything we've covered in this video or other strategies for passive investing, let us know in the comments below and share it with the rest of your confident real estate family. Once again, I appreciate you watching. Until next time.